Morning, it's Harvey Jackson from Produce Profit. Just going to go through a few things. USDA is today. Canada said to retaliate, and palm oil actually had a pretty bad day yesterday. They had a report come out. So let's just get into it here. Canada said it will respond to trade tariffs. Probably the most significant one that is the ethanol and soybean oil exports that come from the U.S. to us. So we'll see if that's actually going to be significant. I think some of these numbers are actually going to be a little bit larger this year, just based on some of our climate stuff that we're doing and the production that's made in the U.S. Here's your trade estimates. I think the most significant one will be the balance on the corn. Expected that a lot of analysts are expecting to see higher demand on the corn. That's by exports and in the grind for the ethanol. So here's the story on the Malaysian palm oil. Inventories drop for December, and here's a bit of a graphic of it. It doesn't look that dramatic, but when I look at it here, the palm oil is struggling to attract fresh buying, and you're basically going to say that these higher prices that palm oil is capturing is actually going to start decreasing. It's too high a price. It rations demand. So the old saying, rationing demand with higher prices, actually do happen. So because the palm oil is actually capturing a pretty good premium over sunflower oil and soybean oil. Chinese soybean imports have been down, so you can see that they're taking larger than usual shipments from the U.S. And they are just slowing things down, which makes sense. But they're basically front loading ahead of the election in October, and they're just by all means just slowing down. Here they're actually talking about crush margins actually at pretty low levels as well. Here's a couple snaps of the weather. It does not look bad in that growing area for soybeans for the next 10 days or 14 days even. So here's just another snapshot of the same thing, just a different modeling, basically saying that there's no problems with the production down there as of yet. And yesterday there was some talk that there was some. So you can see canola is down $4. The rapeseed is down 6. Soybean oil is down 0.7 of a cent per pound. So it's going to get pulled down with the palm. It's only down 1.5% versus close to 3% on the palm oil. Crude oil is down. Soybeans are basically flat, but they had a pretty wide-ranging trade yesterday, and your wheats are all down a couple to a few cents a penny. And Canadian dollar is still trying to make new lows here. Let's just have a look. Approaching your 100-day moving average right there. So, and it looks like it's maybe not wanting to get through there. So it's on the 50% retracement on the move. So we'll see if that actually gives us a little bit of a move up. It's gained a fair bit of strength here. It's still holding some strength, but we'll see how the USDA report gives us, if it gives us any news on the soybean that's going to affect us here. So rapeseed, still $171. Last week's high, close to 200, is still quite a high value, especially over the $100 mark. And I'm not certain what number is the right one, but it is quite quite a bit more lofty than the Canadian canola. So it's starting to find some destinations, of course. So here we are. Here's just kind of the relative value. 522, but and still in a pretty good steep uptrend here, trying to recapture some of those highs that we've made in November. Soybean oil, basically chopping sideways here. You got a few moving averages that it's trading at. It needs to beat those ones there to probably to get back into any sort of range up in this area, which would be supportive for canola, of course. Here's your palm oil, bad day. Pretty big red candle. And here's the 1-day 5-minute chart. So it was down 2.65% just when I take this snapshot. So you can see just as time delay, just how this actually traded. So every now and then I'll look at, dive in to see if there's anything telling into these charts, right? So here's crude oil getting into this descending wedge, and your soybeans, it's downward trend as well. Not trading at the $10 like it was yesterday when I looked at it. But the Canadian dollar, I keep on moving this line down. So we're now trading, 70.87 on the March, and here it looks. Here's a look at it in a monthly chart. We continue to grind lower here, so we'll just see how that continues. It's it's a fact of our economy. It's just doing so poorly with that donkey running this country. So here we are. Wheat broke out, but still sideways here. So there's really no news. But when we dive in and look at it on a monthly chart, we broke out, but it's still very choppy sideways. And here we are. That's still going to be my upside target. Might have to edit it to maybe a lower value at 680, but I think because it's so far away, I think we hold steadfast and put in targets at that $7 futures first kind of contract for spring wheat for next fall, and do it as late as possible, like in that October November timeline. If you need it off the combine, do it October, but later the better if you got storage. Just for basis appreciation that we would probably start looking at logging in the spring. Chicago wheat moving out, trading above the short-term moving average, kind of mid-range on the slow stochastics there. And your hard red winter finally broke out yesterday, and you know, which is a good thing. We'll just see how this continues here. Milling wheat, so that's the French milling wheat, and corn. Corn peaked out above this ascending wedge. So we'll see if it can hold there. If there's going to be some positive news, I think it would be on the corn, just because of demand. If there's anything on the USDA live cattle, and I don't talk about cattle much, but when you see these values, you look at putting some sort of floor in here with puts or something. And again, the report is coming out today at 11 o'clock. We'll chat later.